Welcome back, everyone, and thanks for joining us for What Are Your Thoughts? Season 2, Episode 3. In this episode, we are continuing to discuss what does it take to beat the market. And in this episode, I'm going to talk about specifics on different themes and or types of investments that one can hold in order to put themselves in a position to beat the market, and also touch on a little bit of how psychology and investing might affect the solutions that an investor might implement. So the first one is actually, the theme is the opposite of what you may hear about in articles and from your friends and things like that, where they talk about diversification, and diversification gets preached in investing all the time. And that basically means you hold a little bit of a lot of different types of investments. So if you're holding the S&P 500 index fund, SPY or VOO is Vanguard's, then you're holding 500, a slice of 500 different companies inside of that one ETF, SPY or VOO. Well, diversification, by definition, it reduces risk because you have a slice of a lot of different companies. So to beat the market, right, again, if you're holding an index fund, you're not going to, by definition, because that's not what they're designed to do. They're designed to track an index. So if you're trying to beat the market, you have to actually do the opposite, which is called concentration. So you have to take on some concentration risk inside of the portfolio. And you can do that a variety of different ways. So you can hold individual stocks, you can buy crypto, you can buy real estate, you can own a business, et cetera, et cetera. And so what does that specifically mean? Well, you may think, oh, I'm going to go out and buy 20 to 30 individual stocks, and that's going to be diversified. And that will also put you in position to beat the market. Actually, that's concentrated. Even though you own 20 or 30 stocks, they're still concentrated positions because you're eliminating hundreds of others that you might have access to inside of an ETF. But however, what that does is it not only increases the risk, remember, there's that relationship between risk and return that puts you in position to earn a higher return, which is what you're trying to do. You're trying to beat the market in this case. So you can hold individual stocks, you can buy crypto. One that I've heard just over, thousands of client meetings, it gets brought up time to time, is real estate, where actually people say, I want to diversify my portfolio and take money out of my quote unquote paper assets and buy hard assets like a rental property. I'm like, okay, how come? They're like, oh, we want to be diversified. Well, that's actually concentration. It's not diversification, because what you're doing is taking money out of hundreds and hundreds of different companies and buying one thing with it, in that case, a rental property. So again, it's not good or bad. It's just what the theme would be to put yourself in position to beat the market. And things to think about here are that, again, with the concentration risk comes a higher likelihood that you will have more volatility, right? If the market is up 1%, you could be up 3, or you could be down 3. It just depends, right? So the volatility increases, the risk increases. But again, you're okay with that, hopefully, if you're going to implement a strategy like that, because what you're trying to do is beat the overall S&P 500, which is fine. So again, pros and cons. So the pros are that on the upside, it puts you into a position to hopefully beat the market. On the downside, you could lose more than the market. So what you're doing is the opposite of diversification. You're concentrating your portfolio. And I don't mean to sound repetitive, but I'm just trying to get the terminology out for listeners. So that's the first one. The first theme is concentration. The second one is leverage. So you can use leverage inside of your account. And I'm going to try my best not to get into the weeds with specifics, but one way to do that would be to trade options. And there are different ways to do this, right? If you're on the Wall Street Bets Reddit, a lot of times those people in that are what we call YOLOing their options. They're literally taking their entire account and betting on a stock price movement, whether it's up or down, using options. And as far as options go in general, the I guess most simple definition is that you're using a time constraint. So you're saying, okay, and it could be 30 days, 60 days, a year. You're saying, okay, by X time, you're adding a time constraint. I think the share price of, if we use Tesla as an example, the share price of Tesla will be X dollars, and you can pick either side, up or down. And this is why, how some people can make money if the market goes down. They could use leverage. So, or the market, if their specific stock goes down that they pick, again, if we're using Tesla, they could bet against Tesla and bet that the company, or the share price goes down in a certain time frame and bet against that and increase their return based on that. So, however, if we're going back to YOLOing your account, that's obviously not sustainable, right? You're not going to take your retirement savings. You might not even be allowed to, but in your 401k, which I'm going to cover last, but you can't or you shouldn't take your dollars engineered for retirement or pinholed for retirement and YOLO options. It just makes no sense. It's not sustainable. If it was, everyone would be rich and money would be worthless. However, there are legitimate option strategies that people can use, which I'll touch on here in a second. But I wanted to cover one more topic, which is day trading, and that's just gambling straight up, right? If you're gonna, you can say that the charts say one thing or, whatever. It's just what it is. If you look at the statistics, right, there's a 50-50 chance that, or less, right, the market could stay flat, that the market goes up or down in a given day. So you can just bet on that. And you can say, okay, well, the market's going to go up or the market's going to go down, and you can bet on that. And that's just gambling. So, legitimate option strategies. So, if we're using Tesla as an example, right, let's say that you own 100 shares of it. Well, each options contract allows the investor to control 100 shares. So, if you already own 100 shares of Tesla, you could say, okay, well, this episode's going to get released on tax day, May 17th, so of 2021. So if we say, generally speaking, looking at the past few weeks or months of Tesla, it's gone down. So you could say, okay, well, my 100 shares have obviously gone down. So let's sell a call, and it's called a covered call against those 100 shares so that you at least collect some money. You're selling the call, so you collect what we call a premium. And that's just a dollar amount that someone pays you to buy the call from you because you are selling it. And what that does is say, okay, you're collecting money, and if the stock price stays the same or goes down, you get to keep the money and you get to keep your 100 shares. So it adds a little bit of return. On the flip side of that, if you didn't have the 100 shares, you could sell a put. So there's calls and puts. And I'll let, I don't want to get in the weeds too much, so people can, there's a lot of literature online about cash secured puts or covered calls or things like that, just options in general. But let's say that there's a stock that you want to own, but you don't want to buy the 100 shares today. You could say, okay, let's sell a put against this. And you could collect that premium without owning the stock. You have to put up cash, the amount that it would cover for those 100 shares. Should you have to buy that, right? If the strategy goes against you and the stock goes down, in this case, you would be on the hook to buy the 100 shares at a certain price that you decide on. So again, that sentence in itself was confusing. Basically, what you're doing is saying, okay, I want to buy this stock. I don't want to buy it today. I'm going to sell a put against it and collect some money. And it should be done on a stock that you want to own no matter what. So there's those two. And if you want to look up, that strategy as a whole, a lot of times it's called the wheel strategy. And it's actually a pretty decent strategy to generate a little bit of return. The other one, you could use options for hedging. So, if you're talking about hedge funds, one thing that a hedge fund might do is they might take a percentage of their entire fund and buy puts against the overall market so that if the market goes down, the investors don't lose money. And there's a cost involved to that, right? If you're buying the puts, there's a premium you have to pay as basically insurance so that if the market goes down, you're not losing a ton of money. So there are legitimate strategies, but again, the overall theme here is using some type of leverage, right? You're using, sometimes options can be called, using pennies to control dollars, which is true, but you can also get in trouble trading options as well. So, but again, we're focused on what specifically can you do to put yourself in position to beat the market. So the first one, individual stocks, crypto, real estate, again, those are forms of concentration. So you have to hold concentrated positions in your portfolio. You could also layer in a bit of leverage inside of it if you know what you're doing to generate some additional return. And then the third one, you have to do it in the correct account. So a lot of times, like, clients will have money locked up in 401ks. And what I mean by locked up is that they are unable to take it out and invest it however they want if they're still working at that company where their 401k plan is at. It's not that 401k plans are a bad idea, because a lot of times they get matched. So that's some free, quote unquote, free money that an employer might give a plan participant. But you have to just make sure that you're doing investing that is, with the goal of to beat the market in the correct account. So a 401k, again, might have a menu of options where they might have some passive options like index funds, and they might have some active options. The data on the active options is that less than 50% of those mutual fund managers beat the market. So now you're back to square one of what to do. And just really quickly here, why do 401k plans just have that menu, a set menu of options? Is because they're trying to eliminate investment selection risk, where they are fiduciaries. They have to work in the participant's best interest when it comes to investment choices. So they don't want to give investors the ability to do whatever they want, because that could lead down a road of losing money. So in order to make sure that you put yourself in position to beat the market, you probably have to do these strategies in other than 401k accounts. So things like IRAs, Roth IRAs, taxable brokerage accounts. However, considering taxes, if you're doing this in a taxable brokerage account and you're buying and selling and generating gains and losses, there could be some tax liability associated with that in the form of capital gains tax. So just really making sure that you're setting the table to put yourself in position to beat the market. So looking back here, the main three, you have to go with the opposite of diversification, and you have to stay concentrated. Not you as the, like, you're not concentrated on the investments. You're concentrated with the investments that you hold. So if you're trying to generate some additional return against the market, you literally cannot own index funds, because those just track the market. And that doesn't make them bad. It's just a fact. So you might have to go and invest in some concentrated positions, which will increase the risk. But what you're hoping is that that will increase the return on the back end of the trade. So, also things to keep in mind here are that you should have a plan before you enter a specific trade. So, if you're going to set a stop loss on an order where you could say, okay, if this investment goes down 20%, it immediately sells, that's probably a smart idea. However, you have to be okay with that psychologically before you enter the trade. And the same is true for the other side of it, where if you're going to set an order to sell after a 20% gain and then it pops another 20%, you have to be okay with the money that you missed out on, quote unquote missed out on, right? The old adage is you never go broke taking profit. So you have to make sure that you understand the psychology of more active or being an active trader a little bit more, because at the beginning of the trade, you feel way differently than you do if a trade goes against you or it goes in your favor. So if we were to recap again, the first one is you have to have some concentration and you have to own some concentrated positions in order to beat the market. You could add a layer of leverage as long as you do it correctly inside of the portfolio. And the third one is you have to have the correct account type. And you have to have your accounts at the correct place that allow for you to even invest in individual stocks or crypto or something like that to get yourself the best chance to beat the market. So that's all. I will leave it there. We could go on and on about this, but I want to take the last minute here to say I appreciate all the downloads that we've had. It's been more than I have expected, which has been great. If you are liking the content, please leave a review. Our listening base basically listens primarily on Apple Podcasts, which is cool, but any platform that you listen on, if you're able to leave a review on that platform, please do so. If you like it, 5 stars, please. And also, too, if you have a topic that you would like me to touch on or clarify, or even just questions, you can send those to info@lifepointplanning.com. Best of luck to everyone investing, and we will catch you next time.